for all of us, I know. It's the kickoff to ultimately approving a budget hopefully in May. And so today we're going to hear from our city staff as to what we can foresee in the next few months. So I'll turn it over to the city manager. Thank you.
Good morning, Mayor. Council. Thank you for being here. As you said, welcome to the fiscal year 2027 budget retreat.
Drew, I'm
I think we
sorry.
need to call the roll.
Call the roll. Pat.
Williams.
Here.
Ms. Ramsey.
Here.
Chair Pond.
Here.
Vice Mayor Denton.
Here.
Ms. Curtis here.
You know, in my advanced age, just having had a birthday, I forget these things. So.
You just have to look for the panic look on Dusty's face.
Yeah, thanks.
I'll give you the answer. All right, so we're going to talk about the budget today. I know everybody's surprised by that. So happy Friday the 13th. The agenda today looks very similar to all of our other budget retreat, our finance retreat agendas. We're going to start with how we get to where we are today. We're going to go through the end of the fiscal year because you can't talk about what we're going to do next year without knowing how you're going to finish this year. Then we're going to talk about what we think revenues look like. And as part of that, we'll hear from the HRPDC staff on their economic outlook. We'll talk about what's in and out of the budget and also talk about our debt structure from Davenport and end up with talking about our future fiscal health and where we go from here. I'm going to go ahead and take the air out of the balloon that the budget we're presenting today is balanced both on the operating side and on the capital side. So it's a fairly easy budget from that perspective. Not easy in terms of all the things that we had to take out of the wish list to get to the balance stage. So this is our budget flow process. You know, we really start in August and September of each year as we start to talk about GIOs. And the off years, we're just talking about progress. And in the on years, which this year will be, we're actually doing new GIOs. So we will start that process probably in the spring with some leadership discussion about what the GIO process needs to look like, revisiting those goal statements, talking about progress made, identifying what things we want to test as we move into Future Fests, and then roll from there right through to October where we'll have the GIO retreat and talk about the results of that work. Outside agency requests really kick off the budget process, at least for me. That's when we send out notices to all of the agencies that typically receive funding and agencies that have expressed interest during the year for receiving funding. And so they basically get an invitation to apply for funding from the city. Once they've applied, it goes through any number of processes. You heard about that yesterday from Ms. Matsumoto, the new process that we have for other outside agencies, and then the Human Services Advisory Board, as well as the Williamsburg Area Arts Commission. In December, we begin the heavy lifting. We start meeting with the department heads, constitutional officers, and a lot of outside agencies that receive funding take the opportunity to come in and meet with the budget staff, including me, to go over what they would like to see in the budget. Now, at those meetings, we do not talk about revenues. We don't talk about what we can and can't do. We only talk about what they would like to do and why. Sometimes I provide guidance. Sometimes I tell them they need to go back and sharpen the pencil on something. But at that point, we're really just collecting all the items. Once we have that giant list, then we begin in February working on forecasting revenues and matching that to the wish list and the really hard work of taking things off the wish list to get to the balanced state that we're at today. In March, at the end of March, I will publish a proposed budget based on today's draft as well as the input that I get from you all and the public over the next month. And then in April, we'll continue to refine that and then proceed through adoption in May. In July, the fiscal year begins and we start to implement the budget. And then we begin the process over. So it's a constant loop of finance activity. So let's talk about how we finished. We actually finished FY25 with about $1.1 million ahead. So we contributed that to fund balance. Now, one thing that you need to know is that that includes a healthy remainder from the school system, which we have committed to hold in reserve for them. And so you need to keep that in mind. It was actually a little closer than it looks in terms of that 1.1 million. And then in FY26, we're projecting to be a little bit closer still with 810,000 in the remainder. Most of that will go to fund balance, but there is an amount predicted to be left over from the school system that would again be held in reserve to offset future requests from them related to CIP or operating needs. So that just helps us buffer a little bit. The thing that's important about where we finished, the note here is you all have asked us year over year to be more precise in our budgeting outlook. And so this is evidence that we're doing that. Now, the danger of that is we get closer and closer to that edge. And so we've got to be very careful about not over or under budgeting now than we were before. The budget that we're going to talk about today totals $120 million, almost $121 million. The majority of that increase over last year's budget is due to the library's projected debt, as well as the debt that we're forecasting for the utility system. So those are two projects that are forecasted to be a component of this. Otherwise, the budget looks very similar to last year's. So where does the money come from? Again, these are our revenue estimates. So local taxes come in at 34.8. The important thing to note about this slide is that local taxes includes what I have always referred to as a tourism tax, right? The sales tax, lodging, the meals tax, and now the admissions tax will all contribute in that area. So the fact that that's more than your property tax just indicates that we continue to be a tourism economy. This miscellaneous category, which is more than the other two, really you have to set that aside because that includes revenue from bonds. And so it's artificially inflated as we anticipate borrowing money for the library. Intergovernmental at 12.4, and then all other revenues at 11.1. Projected real estate assessments. This year, we're looking at a 5.2% increase overall. That produces, just so we keep it in context, about $1 million in new revenue. So you can't get real excited about a 5.2% increase. That's not a lot of money in terms of offsetting the increase in operating expenses. So how does that kind of increase affect the citizens? You've got here the chart that we've been showing you for a few years now. This breaks down mortgage holders versus non-mortgage holders impacts from a 5.2% increase. At the bottom, we've added a data point, which is the average increase, 9.78. So when you look at this in total, the average person's home, they're going to pay an increase in taxes of $9.78. If you're a mortgage holder, the vast majority are going to see an increase of $0 to $25. And if you're a non-mortgage holder, 25 to 50 or 50 to 100 is the vast majority of those folks. Here's the regional tax comparison. Not a lot has changed. We increased the meals and lodging tax, and we're still comparable with the region. Other than that, we still remain the lowest tax rate in the region in terms of real estate. And I'm going to show you next. We've updated this information to reflect what we can get from the state. It's 2024 tax year. That's the latest that we can get. And some of the data points have changed, but the majority of the information hasn't. We're still the lowest tax rate of any city in the state of Virginia. We're lower than about 50% of the 98 counties in the state. The closest tax rate to us is Radford at 0.69, and the highest, just for a data point, is Manassas at $1.43 for $100 of value. Now we're going to turn it over to Ms. Johnson, who's going to talk to us about the regional outlook and Williamsburg's forecast.
Good morning. Nikki Johnson, regional economist and the Growth Planning District Commission. Thank you all for having me here to discuss the economic outlook for 2026. Now, 2025, we faced significant federal policy changes and a lot of economic uncertainty. Yet the national economy remained remarkably resilient. But as you'll see today, that's less true for Hampton Roads, where federal cuts have really had an outsized impact on our regional economy. Starting with the most broad measure of the national economy, we can see that in the first quarter of 2025, GDP contracted. This is largely due to pre-ordering to get ahead of the tariffs, which reduced net exports. We then saw a surge of growth in the second and third quarter of 2025. The volatility in the first half of the year was mainly due to the tariffs, but consumer spending was a key driver of growth in the third quarter, latest data that we have, 4.4%. So while both consumer spending and business investment do remain strong, we do expect slower growth moving forward, but a slowdown does not mean a recession. We're likely more to see a normalization back to pre-pandemic trends. We're looking at inflation. After peaking at about 9% in June of 2022, we see that inflation has moderated significantly since then. Inflation did tick up slightly in 2025. That was mainly due to those tariff-related pressures. But while the tariffs have been big on paper, their impact has been somewhat muted in the data. And there's a few factors that are driving this. First, there's early research to show that the statutory rate of tariffs is actually much higher than the effective rate, because many goods are being exempted from the tariffs. Second, and the biggest factor, is the fact that we're seeing that firms are largely absorbing the costs of the tariffs instead of passing them on to consumers in order to remain competitive on prices. And then finally, we think that the full impact of the tariffs is likely to be delayed. It will just take some time for tariffs to fully work their way through to prices, which means that we could see higher inflation in 2026, but there's a lot of uncertainty with that. Just given the stop-start nature of many of these tariffs, we also have an pending Supreme Court decision which could put a stop to some of the president's tariff powers. It will not remove all of his tariff powers, but it could stop some. So there's a lot of uncertainty moving forward. But while inflation remains above target, what we're seeing is that consumers are still spending. In Hampton Roads here, we see that retail sales in 2025 were slightly below the prior year on an inflation-adjusted basis, but they were still well above 2023 levels and much higher than what we saw prior to the pandemic. While retail sales both nationally and in Hampton Roads are still strong, we're starting to see evidence of what's known as this K-shaped economy, where a lot of the income and wealth gains are occurring among the higher income households, largely from a booming stock market and a lot of AI investments, while at the same time, the bottom half of households are seeing weaker income gains and a lot more affordability pressures due to that persistent inflation. And that's part of the reason that I think you're seeing some divergence in economic activity and labor market conditions. Because if we see here, we see that nationally, the number of jobs added in 2025 was one of the lowest outside of a recession since 2003. Now, we just saw a couple days ago the benchmark revisions, so job growth was actually lower. It's not factored into this data, but it was lower in 2025 and 2024. The latest numbers for January, we did actually see a nice rebound, strong job growth. We never want to put too much weight on one data point, but it is positive moving forward. Just need to see how the trend continues. But one of the main factors that we're seeing slower job growth last year is because of immigration. With fewer people, you just need fewer jobs overall. And so there is a question moving forward what our new benchmark level of a healthy job growth is, just with lower levels of immigration. But while job growth slowed considerably nationally, it did not contract. But jobs contracted in Hampton Roads. Hampton Roads lost nearly 12,000 jobs in 2025. While we're still above pre-pandemic levels, that's a significant decline. If we look at year-over-year job growth, we can see Hampton Roads had slightly slower job growth just in the aftermath of the pandemic. But in 2023 and 2024, year-over-year job growth was roughly in line with what we saw nationally, just slightly lower. But then we start to see that break in 2025, right? And so while job growth slowed nationally, it contracted in Hampton Roads. The main factor for that contraction are the federal cuts. Hampton Roads is home to the third largest federal civilian workforce in the country. We lost over 6,000 federal civilian employees in 2025. Now, a lot of those cuts occurred at the start of the year, but the full impact was delayed in the data. And that's largely because the workers who accepted the deferred resignation were still counted as employed while they were receiving severance. And that severance ended in October, which is why you see the decline here. But here we can see the comparison, where Hampton Roads lost a slightly greater share of its federal civilian workforce. This compares levels in December 2024 to the latest data for December 2025. Hampton Roads lost 10.4% of its federal civilian employees, compared to 9.1% nationally. We had a slightly less decline compared to the state at 12.2%. We don't have timely data for Williamsburg, but we can see in the latest census 5-year estimates for 2023 that federal employees represent about 5.8% of residents working full-time in Williamsburg. That's well below what we see in Hampton Roads as a whole and Virginia, but we're still well above the national average. So you still are likely to see some type of larger impact here in the city relative to what we see nationally. If we look at job growth by industry over the past year, this is Hampton Roads data, we can see that the largest losses were in federal government and manufacturing. The largest gains were in healthcare. These sectoral trends are largely what you see at the national level. Most of the job growth nationally occurred in the healthcare sector. Also, the largest losses were in federal government and manufacturing. As I mentioned before, while labor market conditions cooled nationally over the past year, they contracted in Hampton Roads. So Hampton Roads individual employment and the civilian labor force declined over the past year. Individual employment actually fell below pre-pandemic levels that we observed in 2019. We do see a slight uptick in the latest December data, which means that we've likely seen the trough from that decline in those federal cuts. But I suspect we're still likely to see slower growth moving into 2026, just to compare it to what we saw prior to the pandemic and over the last few years. The labor market trends in Williamsburg also mirror the region overall, but we see a slightly less decline, and that's likely just because of a smaller share of the federal workforce in Williamsburg. We see that labor force and individual employment remained above pre-pandemic levels. They also saw an uptick in December from the latest data. As of December, there were 100 fewer individuals employed in the labor force compared to January of 2025, and there were 200 fewer individuals employed, right? So we saw larger losses in employment than we did people actually leaving the labor force. The gap between those two lines represents the number of unemployed. And that's why we're seeing an uptick in the unemployment rate. Now, the unemployment rate ticked up in the US, in Hampton Roads, and in Williamsburg. In Hampton Roads, the unemployment rate is historically below the national average, but that gap has started to narrow over the past year. In Hampton Roads, the unemployment rate increased about 0.6 percentage points since January, compared to about 4 percentage points nationally. But in Hampton Roads, we're still seeing unemployment rates at historically low levels. And part of that is just because individuals who are losing employment are leaving the labor force altogether. So that gap between those two lines is staying roughly the same. And that is somewhat masking overall labor market conditions here. Now, the gap is actually widened, wrong way, in Williamsburg, which is why you're seeing a larger increase in your unemployment rate. Now, the Williamsburg city level data is just much more noisier, and so you're seeing a lot more up and down, but overall we are seeing a greater increase in the unemployment rate in the city relative to the nation and the region. Turning to the main pillars of the Hampton Roads economy, you can see that hotel revenue on an inflation-adjusted basis fell below pre-pandemic levels in 2025, and demand softened. One factor is that K-shaped economy, right? So demand is softening in the lower and middle tier markets, while higher tier markets are still seeing strong demand. And that's why we're seeing softer demand here within the region. And this trend is likely to continue while we still see these K-shaped factors continue nationally. But there is one bright spot in the Hampton Roads economy, and that is defense spending. So despite the federal cuts, defense spending increased considerably in 2025. We had the $900 billion National Defense Authorization Act that's passed for 2026. It includes pay increases for military service members. We also see significant increases in investments for shipbuilding. Both of those are going to be key for the region and a much needed boost for our regional economy moving into 2026. Turning to the housing market, we did see home sales tick up considerably in 2025. Still slightly below those pre-pandemic levels. Prior to the pandemic, we were hovering around 2,300 to 2,500 homes sold per month. We're now at about 2,200. So still some way to go for a full recovery, but this is the first year in about 3 years that we've really started to see an uptick. And a key driver of that uptick is mortgage rates. We saw mortgage rates decline steadily over the past year, which has really eased pressure on home buying overall. We're still at historically high levels, but we are likely to see further rate cuts from the Federal Reserve in 2026 unless inflation surges. They don't set mortgage rates, but it does impact other interest rates like mortgage rates, so we should see a further decline in the 30-year fixed mortgage rate moving into 2026, which should further ease pressure on home buying. Now, while we saw a strong rebound in home sales in Hampton Roads, that's not true for Williamsburg. Williamsburg's continued to see a decline in the number of homes sold in 2025. We're actually at the lowest levels in nearly a decade, still well below pre-pandemic levels moving forward. If we look at home price growth, we can see the rapid pace of home prices over the pandemic. So from 2017 to 2020, we see that home prices increased about 2.7% in Williamsburg, 8.6% in Hampton Roads, and nearly 20% in the US. Now, in the following 3 years, we saw an additional 27.3 percentage point increase in Williamsburg, and Hampton Roads was nearly 32.3%. We are seeing a slowdown in that growth. We're not seeing the same level of growth we saw just during the pandemic. But what we have seen over the past years is that home prices are accelerating faster at Hampton Roads than they were in the nation. And that is a relatively new trend. If we look over the past year, home prices increased an additional 2.9 percentage points in Hampton Roads. They were relatively flat both in Williamsburg and nationally. A key factor keeping home price growth elevated is the shortage of available homes for sale. So prior to the pandemic, the month supply of housing inventory, this says that at the current pace of sales, how long would it take to sell off all of your existing available inventory? Prior to the pandemic, the month supply was about 3.2 months, roughly in line with what we saw at the national level. But then we see as of December, we're at about 2.2 months. The gap between the US and Hampton Roads has really widened, and we're still well below those pre-pandemic. So the tighter inventory is likely why you're seeing faster home price growth here in the region relative to the nation. Rents are also accelerating much faster here in Hampton Roads relative to the nation. You can see in the first, from 2017 to 2020 is slower than the national average, but over the last 2 years, we are seeing much faster rent growth. In just the last year, it's increased an additional 8.6 percentage points compared to just 3.2 percentage points nationally. Now, our forecast highlights some of the positives, which is mainly that defense spending. We really think that will be a key anchor to see modest growth here in the region over the next year, but there is a lot of downside risk. Our other two main pillars are seeing softening demand, whether it's from trade policies or it's just from that K-shaped economy. We're seeing softer demand in our tourism sector. And so those other two pillars are seeing slower growth, but we think that defense spending will be a key anchor to keep us out of a recession. It's also important to remember that federal civilian employees really earn nearly twice the compensation of the average private sector employee, which means, in other words, that you would need 2 new private sector jobs for every federal civilian job loss if you wanted to keep the same level of total compensation here in the region. And because these federal civilian workers tend to be more educated and also tend to be older, it's also harder for them to find a job in the private sector. And so how is that going to affect our labor force and population trends moving forward? That will be a key question. Also, when we look at population growth in Hampton Roads over the last few years, net international migration has been the largest contributor of population growth. We have slow natural change. The births minus deaths is slower. We consistently lose residents to net domestic out-migration every year. So with the changes in legal immigration policy, how will that affect our population growth moving forward? So while our baseline outgrowth does point to modest growth, there's a lot of risk towards the downside. That's all I have. Any questions?
Nikki, thank you. As always, you present a great discussion, and I certainly do appreciate that. You talked about the effects of tariffs, and that we think back to when the tariffs began, there was, great cry by many economists saying it was the end of the world and we're going to hit a depression, but that hasn't come to fruition. And so it makes me curious as to why you would say that the effects of tariffs have yet to be felt. What makes you think that there's going to be something there?
I think when we look at the tariffs that were initially announced on Liberation Day, many of those tariffs didn't go into effect. It's also hard to really judge the full impact of the tariffs because so many changes have been implemented. At one point, we had 100% tariffs on China. That was then pulled back. At that level, trade would have essentially stopped. Then we're at 30%. I can't even tell you what the latest number is. So all of those changes make it really hard to know what the full impact would be. But what we've seen overall is that the tariffs that have actually been implemented have been much smaller than what was initially announced. And that's why that impact has been somewhat muted. We also really expected firms to fully pass on the cost of those tariffs. But I think what we saw is that consumers were just getting out of a really bad period of inflation. It was a lot harder for them to pass on those costs, so they are largely absorbing them at the moment. They want to stay competitive on prices. And I think those two factors together, and then as I mentioned before, that statutory rate. So there are a lot of goods that have been exempted from the tariffs. Those factors make it not what we initially expected. There was a question of, well, will this be a one-time increase in prices, or will this be an ongoing increase with trend? Will inflation actually stay elevated from these tariffs? I think what we're seeing now is it's likely to be just a one-time increase, then consistent elevated inflation, but we still haven't seen that full impact. And that's just because of how these tariffs have been implemented overall.
When we look towards the future, we hear that there's large amounts of investments being made in manufacturing jobs. Is there any? Won't we see that in the Hampton Roads region as well, with manufacturers relocating back to the United States, and how might that affect wage growth moving forward?
So what we've seen so far in the data that's available is manufacturing has been one of the industries with the largest losses. A lot of that is the economic uncertainty that's been surrounding a lot of these policies. That in and of itself has a significant impact. If you're a firm and you want to move manufacturing here, but you're not sure if the tariffs could go away from 1 minute to the next, it's really hard for you to make long-term decisions. And I think that's what we're seeing in the data so far. Now, long-term, will we see an increase? I think that's just still a question. But right now, I think a lot of companies are in this wait and see to see how this all plays out, just because of the uncertainty.
One last question, housing. Obviously, housing costs, both in purchasing house and rents, have gone up. Outside of the 2008 housing crisis where we saw prices decline, do we ever really see decline? Or, now that we're at this higher level, can you imagine that it might prices come down? Maybe just housing costs, not rents so much. I think rents are more volatile. But
Yes. So last time somebody said you never see housing prices go down on a broad level, we saw the housing crash. So I don't want to say that, but I think we're in a completely different environment. I think we're seeing a lot of pressure on new construction. Some of that is because of the tariffs. Some of that is because of the limited labor supply. All of that is increasing input costs and making it harder to build. We also saw the higher mortgage rates, which put a lot more pressure on home buying. So I don't think that you would see a broad-based decline in home prices. I think a lot of this is just a leveling off from the historic growth that we saw during the pandemic. That was really unprecedented. And so, of course, you're going to see a slowdown from those levels. But a broad-based overall decline, I don't see. It's at least in the near term.
thank you.
Yeah, thank you, Nikki. Just one question. Do you have any sense of how AI is beginning to impact the workforce? Do employers have enough confidence in it now that they're starting to look at ways to minimize their workforce?
We have seen a lot of discussion about that. We have seen businesses in earnings calls say they are moving AI investments, but we're not seeing that yet in the data. Right now, there's more discussion if it's just kind of a boost in order to kind of please shareholders that we're making investments and also an excuse as to why we're cutting employees. But overall, right now, we're not seeing a switch. I think the way that a lot of us use AI is as a support tool. It's not, at least in our career and what we see here in real time, it's not replacing jobs immediately, it's supporting jobs, it's helping productivity. And so as of right now, that's how I'm seeing those AIs. We are seeing a lot of investments on the back end, but in terms of replacing workers, there's really not a lot of evidence in the data as of right now.
Thank you.
Hi, thank you so much. Really always enjoy this presentation, despite sometimes what it says. But I do have a couple questions. One of them is when you were discussing unemployment rates earlier, you used a phrase about Williamsburg that I'm not sure that I understand. You said it's a lot noisier, and I was just wondering if you could explain what that means.
Yeah, it's just the size of Williamsburg relative to Hampton Roads in the nation. If you look at the data, it's not such a smooth trend. There's a lot of up and down.
Because we're so small that one data point can really jump the needle.
Exactly.
Okay, that's what I figured, but I also did want to assume.
No, definitely, yeah.
And then my second question is about the civilian employees that you were referencing about, now after October, now being counted. in the way of like really in the unemployment.
Yes.
And what I'm thinking about is how that demographic, as you mentioned, of being highly educated, having made a good wage over the last probably many years, overlaid with the K-shaped economy. And so where do we see that demographic really falling? Are they more likely to be at the top of the K where maybe they'll be okay, right? I've got investments and I'm going to be up here, or are we concerned that that demographic is actually on the downslope of the K and therefore likely to have a lot more challenges that impact what they're able to do?
That's an interesting question. I would say, a lot of that K is from AI investment in the moving stock market, so they're really high income. Federal civilian workers, while they do earn, nearly twice that of a private sector, I would still say they're more in the middle to high, in between there. So it's not necessarily related to that. But I think a big question with the federal civilians is how many are going to have to leave just because we do not have comparable jobs here. If you worked at NASA, is there an equivalent job that you could find here in the private sector? And so a lot of those impacts are really going to be geographically concentrated overall, and how it's going to affect our region more than how it affects broad level trends.
Okay, thank you. Okay. And then my last question, turning to housing. I remember, last year and probably the year before, talking about how the way that the market was is that everybody was just sort of like hunkering down in place. And that causes, rental, rates to keep going. And it's just harder for people to make a move, both metaphorically and literally. And so I'm wondering, are we seeing any change? Is there any breaking of that, of just locked down?
That's exactly what it was, the locked-in effect. If you bought your house back in 2021, you were facing a mortgage rate of 2.7%. If you wanted to then move and sell your house 2 years later, you were facing a 7% mortgage rate. And so it locked you into your home. And that's what really put added pressure on home sales. And that's why we're seeing an increase, at least at the regional level. We are seeing, and nationally, we're seeing home buying increase again because that locked-in effect is starting to dissipate, because mortgage rates are starting to ease overall.
Great, thank you so much.
Thank you. And I have sort of one question, maybe two. So if you go back to that unemployment chart that you had, so we typically think of Williamsburg as having a lot of seasonal jobs too.
Mm-hmm.
So now that we're in the middle or the winter, a lot of jobs, people aren't hiring. So is that somewhat a factor for the employment rate?
It is not, because this data is seasonally adjusted.
Okay.
So we account for that.
Okay. And secondly, when you show Hampton Roads, is Williamsburg included in that?
Yes.
But then on this chart where you show Williamsburg, are we excluded for the Hampton Roads, or are we still in the Hampton Roads?
We count you as part of the Hampton Roads, and then we also pull you out. So we see where you compare to the region as a whole. Right.
So for that unemployment, our 5.9% is sort of factored into the Hampton Roads pool.
Yes, absolutely. And if we were to remove Williamsburg from Hampton Roads, it would still be relatively the same trend.
Just curious. Thank you.
My questions have been asked, but thank you for presenting the information. It's been truly helpful.
Thank you.
Thank you, Nikki. Thanks for coming to Williamsburg. Go spend some money.
I will.
Yeah, thank you, Ms. Johnson and Mr. Rudolph for being here today. It's always great to have the HRPDC. You guys do such great work for the region and also for Williamsburg. It's a good time.
Happy to be here.
All right, so we'll progress on through this. And talk about the city's fiscal health a little bit. You just heard from the economists about where they think things are going and the trouble spots that might lie ahead. Ours looks okay in terms of where we're at. We're going to look at the very end of this chart a little bit. Obviously, we still have this note about COVID, which accounts for this drop here and then the spikes that you see. But you can see from the trend lines for revenues, expenditures, and the budgeted expenses that we're tracking about where you all have asked us to be. You've asked us to bring these points closer together so that we finish the year more in line with what we expect and have less surplus at the end of the year. And so that's reflected here. Fiscal health in terms of the growth of our revenues, everything is trending very well. The one area of concern is sales tax, not growing nearly as fast as it was. So we need to keep an eye on that. As you remember, the city of Williamsburg is actually pretty unique in the state in that we fund our capital improvement plan almost entirely with revenues from sales tax, okay? Everywhere else, that sales tax revenue goes to general fund first, and anything that's left over then goes to the capital plan. So it puts a lot of pressure on that sales tax revenue to support a pretty healthy CIP, particularly as we've added buildings and need to do repair on a lot of old buildings. In terms of the debt, you can see here we're trending pretty nicely. The charts at the bottom show you the proposed debt that's included in this budget. Nothing new that you haven't already heard about. On the general fund side, the library is the only new project. And on the utility fund side, that's just the borrowing that we've already forecasted for and is included in the rate increases. Now we'll hear from Davenport.
Thank you, Trey.
Cameras, if you stand in this zone.
Okay, get me out of the camera.
No,
You're good, how are you?
Thank you. It's been around a year or two.
Mayor, members of council, good to be here, thank you. Again, David Rose, my partner, Jimmy Sanderson, as you know, and Tyler Smith, some future partner, our young fella handing all this stuff out. I'm gonna start the presentation, Jimmy will follow after me. We're not gonna be very long today, just good news, I think, all around. So again, by all means, interrupt or ask any questions, you know the drill. If we don't have the answers for you, we'll get them, we'll give them to Andrew, and then we'll come back to you. So again, thank you, Barbara, Davin, and Andrew for all of this. So again, a little bit of introduction for those in the audience and what have you. Davenport has been fortunate to serve as the city's independent financial advisor for about 3 decades now. So it's been a while. We've seen a whole lot of changes, a lot of things have occurred, but we have been and hope to continue to be your fiduciary. What that means is we're not here trying to sell you on a project, not recommending a project. All we care about is that you continue to do those things, keep your credit ratings up, take care of your budget, do it on a sustainable basis, and be in a mode when the economy eventually goes down or has a recession, that you're in a good position. And again, because of the unique nature of Williamsburg, you're going to see we have some unique reserves and some unique policies that I will tell you, just like Andrew said right up front, you're in compliance. We'll tell you once again, you stay in compliance, and we see no reason that that will continue. Again, you got some credit ratings initially in 2010. I worked with you on that, and then did your first indebtedness about $10 million back in 1990, did that as well. A couple of important things. Last year, and you'll see this in a moment, we did present to you as council in the chambers a specific meeting that was dedicated solely to the debt portfolio. I think there was some folks a little worried that there's a lot of projects, a lot of things being done. The takeaway on all of that, not only from the rating agencies, but from us, is that your ability today to meet the debt that you have is greater than what it was when you did your initial debt some 30 years ago. You've just evolved to that way. And again, that's why your credit ratings have also evolved upward by independent authorities that have no interest and could care less about Williamsburg or Virginia. They just look at you from a very cold outside perspective. They don't live here. And so again, I take a lot of comfort in that, because historically, they may not have done a great job during the 2009, 2010 time on the corporate side, but they were dead accurate on the municipal side, and they've been really important to us. So again, just want to point that out. A table of contents, background. Back last year when Jimmy and I were here, we did a number of things. We talked about your debt profile, and we talked about the long-term financing. One of those things, and Jimmy's going to come behind me on this, you have a bond anticipation note that is due this October. So we said last year we're going to get planning for that to make sure that we take care of that. We're going to do that this summer. That's what we've got to do. In addition, we put into all of the planning last year a $20 million estimate for the library. That number has evolved to now it's $26 million. That is in all of our plans as well. We did a utility fund pro forma and talked about that. Thanks to Jack, wherever he is. Oh, there you are. Okay. We work closely with Andrew, Jack, Barbara, and the bottom line is we successfully got an inaugural financing on a true user base, so it keeps it away from the general fund, keeps the pressure off of the tax rate for those folks. And that was launched. Jimmy's going to talk a little bit more about our next steps. We'd like to get your blessing to continue to do that. And so then the other thing we did post this presentation, roughly in the February timeframe, was, as I mentioned, we made a very in-depth presentation back in August. The debt profile talked all about that. And then we, again, moved forward with that inaugural for the city's water and sewer. We call it utility system revenue bonds, because, again, user fees take care of that. And then finally, we completed the HTRFA sports complex. All of that to say that we are going to recommend, and Andrew concurs, to bring the rating agencies down here to see the city, and they have not been here in years. In fact, it's been so long, I have to kind of go back and think about it. When they were last here, it was mostly for James City County, but we think these things that have happened, all of the things that you've done, it's so compelling that we think the way to maximize and continue to improve on and keep our credit ratings is to let them see boots on the ground. And we hope to do that roughly in the June timeframe once we get through the budget and all the things that you've got that Andrew's talking about. So goals and objectives for today, again, just revisit the city's financial standing, talk about those key actions that have occurred, talk about those key things that need to do go forward on the multi-year CIP, and then just generally give you a sense of the time frame for all of this. Okay, I always like to do peer comparatives. It seems like the Ms. Johnson or Dr. Johnson, the economist, did a good job of that with regard to those types of numbers. We'll do a little bit less scientific. Don't have a PhD in economics, so I'll give her that. We basically want to just talk a little bit about just where you stand. Andrew talked a little bit about this. So we just take the region, and then we talk about credit ratings. So you've got two major credit rating agencies that cover us, Moody's, Standard & Poor's. Moody's today is one step away from AAA. Standard & Poor's is at AAA. People always ask us, is one more difficult than the other? Not necessarily. We can see it flipped in other places. But I think the point here is when we first had our credit ratings, we were nowhere near these types of levels. But we've moved up to these levels because, again, you have good self-imposed policies. You are structurally balanced, like Andrew said, and will be again. You've added to your fund balances, which is a good thing. And again, from a citizen standpoint, if I were there where my parents used to live when they were alive here and were obviously residents, this was a city that operated well, continues to operate well. And again, that's important. So real estate tax rate for the region, which of course includes the counties, you're still in a very favorable way. Most counties tend to be higher around here, and you can see that. And then again, where it really shows up, as Andrew said, is real estate tax rate statewide, you're at the lowest. So again, very, very positive and a good position. With regard to some of those other big drivers, meals tax, once again, you compare favorably, you're in the thick of that tax rate. You'll notice there equal to Norfolk and Suffolk, but below the Hampton, Newport News, your neighbors, if you would, and Portsmouth a little bit further away. So again, a competitive meals tax rate. Similarly, lodging tax rate as well. Most of those places, again, tend to be a point higher at 8%. Taxable assessed value. Again, you're on the small side relative to, again, those that are AAA. I think that's a real important point here. You tend to be about the size of some of the AA communities, but again, you're right there in a fraction of the AAA communities. Most of the rating agencies tend to feel better when it comes to giving a AAA for places that have a larger population. Their theory is it's easier if there's a problem to spread the debt, to take care of things, if you have a bigger population. So for you, having a modest population and to be that highly rated, that means they're very comfortable with the way you're structurally set, and that means that you also have, from their perspective, some good reserves, and I'll get to that in a moment. Lastly, when it comes to assessed values, they also look at this per capita. And you can see here, you basically are well over $200,000 per capita. And you'll notice here that that puts you right in the thick of the AAAs, much higher than the AAs and the single A's, and then nationally, again, within shouting distance of sort of the national AAAs. So once again, you'll find that this area, the cost of living here in the region is actually lower than where a lot of the AAAs you'll find into around bigger cities and counties nationally. So again, we are looked at as a good value, a little bit of that impact, but this is still a very good ratio that rating agencies use. So I talked a moment ago about saying fund balance. We've banged this drum over and over again. What we want to be sure of is that the city has a robust, what we call unassigned fund balance. That's a fancy way of saying rainy day fund. Now, you may say, well, I've got all those dollars. What do we do with them? Maybe they should go back into the citizen's pocket. They actually do. What happens here is that that unassigned fund balance, those dollars, they earn an interest rate that really goes back into helping keep your tax rate down, because you get 7 figures of interest earnings every year. In fact, we sold bonds yesterday for the city of Virginia Beach, and we sold actually the day before, and the all-in cost of money for 20-year fixed rate debt was about $325. Fixed rate, 20 years. We are running all of your analyses at 5% and thereabouts, but the important thing is we're able to actually earn an interest rate on those dollars sitting in your bank account that's higher than the cost of money, fixed rate. So we're really in a very good position. It's part of why you want to do some pay as you go, but it doesn't make sense to turn around and take extra dollars and just pay down debt. This is more cost effective to take those interest earnings and plow them back into the general fund. So wanted to point that out. The other thing you'll notice is that 35% is quite high. There's a reason for that. When we set that policy years ago, we know that Williamsburg is vulnerable given its tourism. It's a blessing and it's also a challenge in a tough year. So having a very sizable unassigned fund balance has always been something critical to help offset uncertainties with anything like that. Just to give you a sense of how it compares again, from just a pure comparative, even though your size is smaller, you're still very much in the thick of AA and AAAs in Virginia. But then when you look at it as a percentage, we like to tell AAA local governments about 20% is a good number. That's typically what we shoot for, and you're at 50%. Basically. So again, a very, very solid place to be. We like that conservatism. Hopefully you'll continue to keep in that mold. Now I'm just going to go quickly on the debt and then turn it over to Jimmy. This is your portfolio, the dark green. The light green is that takeout that we're talking about. Jimmy will talk about some more. We put some estimates in for debt service. So you can see here, we're going to be planning for and talking about all of that as it ends up. We did this last year. There's no surprises here other than to say that if interest rates stay approximate to where we hope they stay, that debt service will actually be lower than what we're projecting, and the impacts will be lower than what we're projecting. Couple of important points. We've got some guardrails. We've got some self-imposed policies. I think visually it's real easy to see. You can see this one. This says how much of we call it your debt to the overall assessed value, the debt assessed value that is tax assessed value. And you can see here, we don't want to really go above 2 3/4, 3% is the total ceiling. We're less than half of that. And you can see it comes down rapidly, and that's an important point. Then we'll show what happens when we add in some debt per the plan. Next one, and I think this one, is the one that we can really relate to, citizens can, and this is your debt service to expenditures. I like to call this your credit card. So the question is, how many pennies of every dollar goes to debt service? Think of it this way. If you're fortunate to own a home and you have a mortgage, let's say you have a mortgage that is, again, at a certain dollar amount, most lenders don't want you to be above 25% or 25 cents on your monthly, let's say, paycheck to go towards a mortgage. We have a policy that we really don't like to go above 10 cents per dollar for our paycheck, if you would, the proverbial city paycheck. Where we are now, though, is we are basically below 5 cents on that. We're about 4.9. Looks like it'll pop up to near 6. I really don't think so. I think with the way the debt will be properly structured, plus with the interest rates, I think we'll be comfortably in the low to mid 5% level. So think of it this way, basically giving about 5.5 pennies per dollar towards debt service. And that's another strength from the rating agency's perspective, is that we're well below our policy, and you can look at, when they look at other Virginia local governments, still well below those levels as well. So with that, last thing is our payout ratio. What this basically says is we like to see paying out the debt after 10 years, about 50% of it. What does that mean in layman's terms? Someone told me earlier, try to speak in layman's terms. So I'm going to try to do that. So if you think of it, if you've got that mortgage that's out at 30 years, the average mortgage after 10 years, 25% of it is paid off. So if you have a $100,000 mortgage, after 10 years, you've paid down about $25,000. In your instance, right now, after 10 years, you paid down about half of your overall debt. That's solid. The goal aspirationally is to be at 60%, and we're going to stay below that for a while because, as I pointed out last year to this council and to the citizens, we've done a whole lot of projects and have some more to do to kind of get caught up over the last several years. So that's the one thing I will say. Our payout ratio is skewing a little lower, but the key is we're using not a whole lot of dollars to take care of that. And really, that's the most important thing. We're not setting the debt up to be pushed out. It's just a matter of doing a lot of projects over the last several years and the next couple of years. So with that, I'll turn it over to Jimmy. Any questions? And certainly, Jimmy, I said maybe you want to correct or clean up or something.
Don't be wrong.
Okay.
Again, Jimmy Sanderson, good to see everybody again. We're going to go through the plan. David hit on a number of these things as we set it up. I love this screen because I can actually see the monitors. Aging eyes. So this is just an overview. We've issued about $35 million of debt in 23 and 24. David mentioned we've had some big projects, the police station and some other capital projects. The 24.5 million of that was issued as a ban. We're going to talk a little bit more about that in a minute, but that needs to be refinanced. We're going to come back to you over the summer and take that out on a long-term permanent basis. Has to be done before October of this year, but we're going to obviously make sure we do that well in advance. The library, again, that's something we're going to look at. We've increased that amount in this analysis you'll see shortly from 20 million to 26 million. And then the last piece, we're looking at, again, this depending on the timing of council, that's going to be looked at next fiscal year, but in calendar year 26. This is a little bit of what we've done. Again, a little bit more of the detail. The 2022 bond issue of 24.5 million, that was issued as a ban, carried an interest rate of 3.1%, very good interest rates. We've just been paying interest on that. Has a final maturity out in 2032, but it's subject to a put in at the end of this year. So we would have to reset that rate. That was all planned. And again, we're going to take that out in the summer or fall of this year. David mentioned maybe even get the rating agencies down here to look at Williamsburg, because we think there's a lot of good things to look at. We talked about this last year. The transaction we did in 23, a little north of 10 million that went to the police station as well. That was a rate that was fixed at 4.59% that's locked for 10 years. It had a longer term amortization, but the banks at that point weren't going out as long. It's callable at any time at par. And so we talked to you last year. It was made sense to look at it, maybe doing a refunding with it. We're going to talk in greater detail about that, but it went away. Interest rates rose after Liberation Day. They come back down now. And David talked a little bit about that GB's transaction. So this now makes sense to look at again. And we're going to talk about how we're going to do that shortly. The last piece, again, is the 26 million for the library. Again, we're going to propose to look at that as a ban later this year. Again, we've got that baked into our analysis as well. A permanent financing wouldn't take place till FY30. So similar to what David showed with your current debt, this now adds in all of the future debt that we're looking at as well. So we want to be able to look and plan, take into account the debt that we know is coming online. And again, we're still here. You can see the high point just north of 2%. I think David's right that we're going to probably come in below that as well. I'm sorry, this is debt to assessed value. Debt to assessed value probably be about where we were. That'll be around another 2%, but it's still well below our planning levels. Debt service expenditures, what Dave was talking about, where it does go up a little bit. Given the fact that we're using higher interest rates in our planning at 5%, in particular, the transaction that we're looking at now will be below that if rates hold in there. So again, this gives us room in the future as we do pay down our debt, and maybe we have other projects to take care of as well. We have done some what we described as generational projects. Went a little bit to the payout ratio that Dave was discussing as well. So we've been able to take care of that well within our parameters. We talked to you last year about how we're going to pay for this. I know that Andrew's going to be talking about this later. We converted to a penny analysis. Doesn't mean you have to raise real estate tax rates to get to it, but it's a good way for people to understand what the impact of those future growth in your debt service is going to look like. And we show it here really for you two ways. On the left-hand side, it's over time. So if you were to just increase the tax rate in the year that you needed the money, so when your debt service increases from where your current budget is, it wouldn't be until FY28 you'd need a little more than 4.5, right around 4.5 pennies, and then there'd be just some little ones that you added on for a total of 5 pennies. On the right,
I could.
yes,
That's assuming that there's not a natural growth in values.
We do assume a 2% growth, which is relatively small compared to where it has been historically. If you were to do the penny increase all upfront at one time, it would be just north of 4 pennies that you would need to do. And again, I think Drew's going to tell you, you've already baked in a lot of that already into your budgeting.
Hey, Jimmy,
Yep.
make sure but they need to know the 5% is so much
Yep.
above.
Yeah, the interest rate that we assume for the future borrowings are 5%. So again, that's also going to get this number down as well. I think last year we were saying between 3 and 4 pennies, probably closer to that range. The refunding that we looked at again, was done with TD Bank, 4.59%. We're gonna recommend a dual track of this. It's kind of interesting that if you look at the markets today, banks are actually charging higher rates than they are in the public market. So we're gonna look at both of them. This was a bank loan, but we're gonna go and look at VRA too, which VRA is a state agency, the Virginia Resources Authority. And they do pool programs. We talked about it last year, and we can apply to them. We did apply to them last year and had conversations with them. But again, the refunding went away. It didn't make sense to do it, so we pulled out of it. But we're back with them again. We're going to talk to them, but we're also going to go out and talk to banks because you never know. You get a good interest rate from a bank, and it's easy to execute. The VRA transaction wouldn't be price for another couple of months, right? Mid-April. So we wouldn't be able to lock in that rate until mid-April. So talking to banks now, we'll see what they will get back to us. But our plan is to come back to you in the next month or so with what we get back from banks and compare that to what VRA looks like as well, and then we can make a decision from there.
Let me just make a couple comments though. Number one, for us to go to VRA or to talk to banks does not cost us anything. So that's number one, they don't charge anything. Number two, in order to look at all this, what we would get is to make sure that ahead of time, the city council approves what we'll call a certain bottom, if you would, minimum savings target, which is tied to best practices that the state generally follows, the Commonwealth. So as a result, when that date comes, let's assume that we take bank bids and don't like the bank bids or feel like they're okay, but we want to hold off and look at VRA, which we can do. We can say to VRA, we're only going to move forward if you produce a certain minimum savings. And the important thing is when I say produce, it's done competitively. The VRA puts this out into the marketplace, and any and every investment firm tries to bid. Whoever has the lowest rate wins the bid, if you would. So it's not like VRA sets it. They just act as the conduit. So I just want to point out, the collective we, control the process as opposed to abrogating it to VRA or something like that.
Maybe what I think to put it back, because we'll come back and talk to you about it. We've historically tossed out like a 3% savings threshold. This one may be a little different. I think we're going to have a conversation about it in particular because the rate on that bank loan is only locked in through 2034. So that's one where we'll come back. We'll see what we get back from the banks and what VRA produce. But again, that might be a little bit of deviation from what we've done before with you. These are just where we sort of stand now. We've compared a bank loan to VRA. Again, we've assumed a 4% interest rate from the bank. VRA is a little bit lower. That's a conservative number, I would say, from VRA as well. The savings, gross savings are much higher with the bank loan. You've got fewer costs associated with the bank transaction, which makes it a little bit easier to execute. So again, we'll come back and compare these when we actually get the bank loans in hand. And you'll be able to see exactly what that interest rate is. Again, the VRA one is one where we have to wait until they actually price before you know what that interest rate is. But as David noted, we would put in parameters to make sure it's not executed if we're gonna lose money. We're only gonna do it if it's safest money. Again, we can go through this a little bit, but again, we touched on a lot of it. You're gonna get proposals at hand from banks, so we'll actually know exactly what that interest rate is and then be able to compare it to what VRA is. And again, David noted it here, the last point again, submitting that RFP application to the banks and then submitting the application to VRA doesn't obligate us to move forward. We'll actually be able to see what those interest rates are and make a decision as to whether it makes economic sense or A couple of overall observations, and David, you can jump in if you'd like to here. A lot of the points that he hit on, your tax rate, very low. Obviously, that's a good thing, gives some flexibility. Citizens like that as well. You have taken on some large projects over the last 10 years. The Stryker Center, the fire station, the police station, all of those go into the analysis that we look at in the rating agencies. We've got the library as well. And so given those, you've done a good job of being able to pay for it and keep your overall tax rate, again, at one of the lowest in the area. You have produced those structurally balanced budgets. Those are extremely important from the rating agency's perspective. And again, your fund balance, the rainy day fund has increased significantly over the past decade. And that's going to give you a lot of flexibility if things don't go as planned, just sort of economically in the area. The last few points, again, we've updated our CIP. It's now just north of $60 million. You've already done 34 million of that. We've got to do that 26 million takeout later this year. That penny impact, 4 to 5 pennies, probably going to be lower than that in particular, given where interest rates are right now. The refinancing, we've not factored that into it at all either. So if we could save some money on the refinancing of that one piece, that would be a benefit to that analysis as well. And again, you still are in line with your debt policies, in particular, debt to assessed value and debt service to expenditures. On the utility fund, again, David noted a little bit earlier, we did a pretty significant review last year, and we executed the transaction using just utility funds. We're going to come back to you as our suggestion. We're going to get with Jack a little bit more. We want to dig into the CIP, particularly as we did that funding last year, see what we have funded, whether we're pushing back some of our costs later or not, see whether we need to do anything. But it's going to be important to make sure that that maintains and continues to be a self-supporting utilities fund. Again, you increase the rates last year. I think we showed that rate increase last year was less than it would have been if you'd been doing over the years, going back a number of years, 10 years or 15 years or so. So it's going to be important to look at that on an annual basis and see what that rate increase may need to be in order to keep up with the fund being, in particular, self-supporting and not relying on the general fund. We took care of that first transaction, $10 million CIP projects. And the last point, I guess, is we're going to get with Jack. I want to set out what the CIP looks like in particular, and make sure we're coming back to you to see whether we need to do any rate increases in the future. I don't think we do right now, but we're going to have to look at that a little bit more carefully. The debt service on the utility side, you'll see here, again, this includes the takeout of that band that we issued. This is going to have some additional debt layered in it. The one thing you'll notice here is we go out a lot further with utilities, how far we finance the debt. That's pretty typical. On the general fund side, we like to keep it to 20, 25 years. On the utility side, we'll go out 30 years, sometimes even longer, generally because those are assets that have much longer useful lives than the general fund side. That's it. Happy to answer any questions.
Well, thank you, Jimmy and David. Appreciate the update. Clearly, we're looking, as you point out, we've taken on, Stryker, fire, police. How much debt do we have that's older than Stryker up top of your head? It can't be that much.
Yeah, it's probably not that much. Hard to tell. We've done some refinancings over the years. When we have done those refinancings, we don't extend the debt either. We keep the same final maturity. So there's probably not a lot of it left.
Maybe parking. I know that parking deck in High Street we paid cash for when we did that. And I say that because we're in this high debt period of our history just because we've taken on these projects. But as we look forward, I don't anticipate outside of the library that there's going to be a big municipal project that we'll take on, and so we'll see that debt start to wane off over years. Except for the city council, in 50 years, we'll have to build a new fire station, police station, library, and figure out what to do. Ayana will be here to figure that out.
The other things you've got with your existing debt too is, you're going to be paying it down. you'll have the ability to refinance it over time too. So we might not have to layer in new debt, but you'll even have the opportunities over the years to refinance when rates go down and lower that interest rate.
And the other thing too, though, is remember that you've set the bar, meaning you've got certain dollars already dedicated to debt service. So as time goes on, you start paying them down. One strategy we do with lots of local governments is to say, as your debt, let's say, starts to move down, it's going to be a few years till it does that. If we continue to keep the debt service level, this is basically in the 2030s timeframe, then you're basically building up, let's say, another kind of reserve fund, like a debt reserve fund for future projects that right now we don't even know what they are. So we think about that.
Yeah, here.
Yes, it drops down.
Yeah, so you have we call it, it's a natural decline in your debt service here. And sometimes it's either, once you get out to 2038, if you've got new debt to add, you might not have to go above where you currently are budgeted.
And when you look at the credit card, and we try to stay under that 3%, that 3% is going to be, the percentage will stay the same, but it represents a bigger number as we go further down in history. Yeah.
Right?
We do
that'll grow.
We do use a very low denominator, though. The 2%, if you look at historically, even with the cyclicality, we're still on the low side. But I think the one that we really care about is the next one is the amount of pennies per your dollar of your budget. I think that really is the big driving. We showed, if you remember, Mayor, like last year when we did our initial debt back in 1990, even though it was just, relatively speaking, it was 10 million, that was a very big chunk of debt to take on. That 10 million, that debt service in that environment was actually bigger as a percentage of the budget than this is. So
And we're only growing this at 2% as well.
Yeah.
Our expenditures are growing at 2%.
That's very
Thank you. I don't have any questions.
No, I don't actually have any questions either right now. Surprisingly, I'm very clear. I appreciate, you did use a lot of civilian layman's terms, so thank you for that. But right now, I'm okay. Thank you.
Same for me. Thank you.
I do have a couple of questions in regards to the rating agencies. So would that be both agencies coming back and looking over everything? And then what would take us, I guess, with, I think it was Moody's, to that top tier?
Yeah. So we would bring both of them down here. Generally, when we do a tour, take them around, show them the things that we've done. David mentioned they probably haven't been here for a while, so that's a good thing to do. And frankly, we often show them the challenging areas too. We want them to see what the city looks like, what we have to take on. Getting Moody's to that AAA, I think that the main driver there is population size. No, I would say that's really it. That may be the ceiling for them. And that's a great rating. The difference between AA plus and a AAA from an interest rate perspective is not a lot. I mean, we even talked about it when we were first looking at all of the stuff we were taking on, whether that AAA might be a little bit in jeopardy. And right now, the rating agencies haven't, but that doesn't mean that they won't. And that even said the difference between a AAA and a AA plus credit rating from an interest rate perspective is pretty low.
Thank you.
Gentlemen, thank you.
Absolutely.
Appreciate you coming in
Thank you
today.
so much.
Look forward to hearing from you maybe next month or the month after.
See if they're on the ground.
Okay. Thank you guys from Davenport. Always good to have you guys do the independent analysis of city's finances. We're going to now turn a little bit from the budget, just talk a minute about performance indicators and performance management as a part of the budget. And it's a critical part because as we think about how do we budget, why do we budget for what we do, it's all connected back to our strategic planning process. It's basically a three-component piece that develops the needs analysis for what we put the money where, right? So we'll start with our strategic planning roadmap. I'm putting this up because it's coming. We're going to be doing the GIO process in the fall, and so we need to start talking about it now. So we'll be doing the future festivals, the online survey, and all of that stuff based on our pre-work to determine what we're asking the public to comment on, and then that will help us develop a new set of initiatives with the city council in the fall. Once we've done that, how do we measure performance? And we do it in a bunch of different ways. The first step, and really the overarching concern, is the city council has set a vision for what Williamsburg will be in 2040. And so we are constantly marching toward that destination. That's the first step. The second part is the independent initiatives and goals, the goal statements that fall into that vision. So the goals are the things in each of those categories that define what that vision means in terms of work product. And then to get there, every 2 years, we establish a whole set of initiatives under each one of those goals that the departments and the city are responsible for getting accomplished in the 2-year period. Most of the time, we get over half of them done, but some of them are multi-year tasks, and so they get broken down. One of the things that we do as a staff is after the initiative is set, we go in and define individual steps required to get to the finish line. We use a digital product called Monday.com. You can find it on the city's website and follow along with the progress and see all the steps that we've identified toward completing that initiative and ultimately satisfying the goal, which then satisfies the vision. The other component, and this is what we're going to talk about just for a minute today, is key performance indicators. This is work that we began during COVID. The department heads and I worked through a process of establishing 5 key performance indicators for each of the departments relative back to those goal statements. And the work is actually kind of simple. What I said was, look at each one of the goal statements, identify a component of the goal statement, pull that component out and define a key performance indicator that you're going to try and satisfy that will move the ball forward on that particular component of the statement, right? And so that's what we've done. And then the final piece of our hierarchy here is performance metrics. These are the daily tasks of government, and we report on those in the budget. We report on those in Williamsburg Weekly. We report on those in the monthly reports that you get at the city council meeting. How many building permits did we issue? That kind of stuff. The normally daily stuff doesn't necessarily advance us toward completing the vision or the goals, but it's the work of government. So we're going to take just a minute and talk about 3 examples of this key performance indicator work. And we're going to start with, I believe, WRHA.
All right, thank you. Okay, all right, well, good morning, everybody. I'm Tyrone Franklin. I'm the Executive Director for the Housing Authority, and I am going to present to you today the KPI number 1 for WRHA. It focuses on One Williamsburg, and if you look in this corner right here, it kind of highlights the area that we're talking about, and that is promote a variety of housing options. So the initiative here is affordable housing implementation, and what are we trying to achieve? We want to increase the number of units that will be available in our workforce housing. We manage a workforce housing program for the city, and that's essentially where we provide housing for our employees at a very, very reduced rental rate. How are we going to do it? The 2 opportunities here, one would be to evaluate existing housing authority workforce housing properties for opportunities to renovate and expand for additional units. And currently right now, we do have a property that we're doing renovation to. And so we're going to complete that and add some additional units. So what are the results we're going to achieve by doing that? Right now in 2025, we can't say we've completed it. We don't have any units. But in 2027, 2028, the GIO, we have plans to have completed that unit. And by virtue of doing that, we will get completing that property. But by virtue of doing that, we'll get 2 units out of that. And then the stretch target would be to get an additional unit, so have 3. Don't tell me how, don't ask how we're gonna do it, we're gonna look at it.
I wish I could look at things and make it happen.
See, I said I was gonna be in my best behavior.
Leave it to me to drag you out.
Okay, we did it. So, I can't tell you. Look at me. I can't tell you how we're gonna do it, but we're gonna do it, because we get things done. But you say, okay, how you do it, you have to have money, right? So the cost, we anticipate $100,000. And we've programmed that into our CIP. And so that will be how we achieve this KPI. But I will say this as a final note, currently, because we've been doing this for about 6 years, when we first started this program, I think we had a total of 5 units. We now have 13. So we have very great ambitions to keep this going. Right now, we have a waiting list for employees of about 10 people, which is a big list. And this is an incentive, because if you've been paying attention, there is an affordable housing issue everywhere, not just Williamsburg, but everywhere. And you want to provide opportunities where people can afford to live where they work. So kudos to the city of Williamsburg, because that is happening with this program. And with that, I'll turn it over to the next presenter. Thank you.
So I have a question.
Oh,
So
sorry.
the $100,000, is that to do the 2 renovated units or to stretch to the 3rd unit?
All right, so that's our budget. And in that budget, we take care of general maintenance for the entire
Workforce program
program. But with these resources, we feel like we can accomplish the goal.
of adding
So
3.
that,
Don't forget, he's gonna look at it. That's gonna make it.
Right, yeah.
I believe in you.
Yes.
I appreciate that, because you gotta have folks believe in you, because why do it, right?
Thanks, Tyler.
Thank you.
Got the right moves on too.
I'm prepared for it.
Good morning, everyone. I'm Tavia Griffin. I'm the Director of Planning and Coast Compliance for the city. And first, I want to thank the City Council. This GIO and this KPI is actually looking at something that's already in the budget. This is a comprehensive plan update. And so thank you for graciously being able to budget that this year and for the next year. So, again, we're looking at the initiative, the comprehensive plan update, and the goal that we have is innovating a modern city. In that, we're going to respect our past and build our tomorrow. And as you know, the comprehensive plan is a requirement in the state code. Every locality in Virginia has to have a comprehensive plan, and then every 5 years, the state asks us to review that comprehensive plan and to make updates. The last time that our comprehensive plan was reviewed was September of 2021. It was actually approved in September of 2021, so we are in line for an update. And if you've been anywhere at a city council meeting or at a planning commission meeting, things that always come up are density and housing and transportation and utilities and project projections and if we're going to grow and where we're going to grow. And so it is time for us to look at an update of the plan. And one thing we also know is that how we engage and how people engage has changed over time. Changed specifically with the pandemic. We see that more people are online, using social media on public platforms. And so one thing we want to make sure that we do is to get people engaged with the comprehensive plan update. So what are we going to achieve? We're going to implement public engagement activities throughout the comprehensive plan update that really look at talking to people who live, work, and visit Williamsburg with multiple ways of engaging with them. And that is online platforms, that is going to them, that is having pop-ups where we actually pop up in different places and have people that are coming in wherever they're going to be, we sit down and we talk to them. How am I going to do this? How are we going to do this? We're going to explore and implement multiple public input tools, develop a public engagement schedule and programming, and also promote engagement opportunities on all city channels. Our easy target is 20 engagement opportunities. And I showed this to my staff and they didn't question me, but they were questioning me behind the scenes. And one person had enough courage to come and say, well, can you explain that? And I did explain it. It is not so much face-to-face, but it's also that public platform that we're going to use. And our stretch target is 35 engagement opportunities. Again, this is already in the budget, but we've broken it down. A portion of the comprehensive plan budget, $106,000. And you may ask, well, where did you get that number? We received 14 proposals for the comp plan 12 of those, we actually, 2 of them we cannot use because they did not meet procurement standards, but 12 we did. And looking at their line items, we've averaged that out, and that average is $106,000 for that public engagement piece. And then public input platform, that is a platform that we're putting into the comprehensive plan budget. That's $24,000. That's not separate money. And then I looked at staff time. All of the planning staff, if they worked on this for 40 hours over so much time, is $6,500. So this is an approximate amount. If you have any questions, I'm happy to answer. Okay, thank you. The next person is Chief Judge.
Well, good morning, Mayor, Vice Chair, members of council. Appreciate the opportunity to speak with you today. We're going to be talking about the police department and our opportunity to increase proactive patrol and community engagement throughout all operational areas within the police department. How are we going to do this? Well, we'd like to be able to add 6 additional police officers, and including their recruiting, hiring, training, and actually bringing them on board. What we anticipate this does for us is a number of things. As we talk about increasing our staff, we talk about the opportunity to be able to do more traffic stops, more summonses, more arrests, that sort of thing, but also just engaging with our community more, having more opportunities for officers to be out of the car, experiencing engagement with our community members. Extremely important to us, and we really do feel like that's a big part of the success that we've experienced. Right now, as you know, we've, unlike a lot of departments, we've broken down our police department. Rather than just having police officers patrolling their quarter or their fifth of the city, in addition to that, they have a smaller area that we refer to as their NRO area, their Neighborhood Resource Officer area. Right now, we have 20 of those areas. With 6 additional officers, we would be able to break that down to 26 areas. And so officers would have a smaller area and an opportunity to have a greater impact on the communities in which they serve. Our current officer-initiated interactions, and again, this may be traffic stops, but this may also be just that out-of-the-car experience where an officer sees some kids playing in the park, parks his car and gets out and talks to kids in the community to build that sort of engagement, that interaction, those relationships that are so important. Between October of 24 and September of 25, we had approximately 16,464. Our easy target with the added 6 police officers is to increase that about 5%. That increased us to 17,287. And then our stretch target is about 17,616 or 7%. So we do think that it would be very valuable for us and the community. And we certainly think that it would be a great step forward in helping us to keep our community as safe as possible. But with that quality of policing that we know you guys know is so important, rather than having a minimal staffing of 4 per shift around the clock 24/7, this would give us the opportunity to change that from 4 to 5. So there will be a 5th available officer around the clock for our community. And as you guys know, there are times where our community members would like for us to be more focused on a particular concern that they might have or a particular problem that they might be dealing with. This will give us opportunity to, I think, be much more successful at that. So I appreciate your time. I'm happy to answer any questions.
Thank you, Chief. Any questions?
So I have one question. I know we've talked about retention over the years. What has been the past couple of years in terms of retention for the overall police force?
Well, that's a great question. In fact, the city manager and I were just talking about that. We've been positioned extremely well, I think, with the new building. We have a team of folks that are excited about the new building. I mean, we couldn't be more grateful about that. You guys have been in our current building, and it's time for that. It's time for that chapter. But I can tell you that's very motivating for our staff. I mean, they really, really feel really good about that. Everybody's really excited about getting in that new building. But I do know that there are some, all the localities are trying to boost that pay. All the localities are trying to do more to recruit the best officers as they possibly can. And so, as we get into that new building, it's going to be interesting to see as we transition to that new building, what that retention looks like moving forward. But right now there's a lot of excitement, a lot of enthusiasm to get in the new building. And I think that's allowed us to hold retention pretty well.
So you aren't seeing people leaving right now. It sounds like those who might have some interest are waiting for the new building to see how that might impact their working conditions and morale and everything else.
Yeah, and how maybe we do as far as keeping up with some of the neighboring jurisdictions in terms of compensation and that sort of thing. So, yeah, we definitely know that there's some interest for some folks. I would anticipate in the next 3 to 6 months, potentially we start to see some gaps, if you will, in our retention. I hope that's not the case. And again, city manager I've talked about, he's got some excellent plans, I think, to help us to avoid that sort of situation. Great question. Thank you.
I know it's always hard.
It is a challenge, and law enforcement is not getting easier, as you guys know. It's not getting easier, and some things, other counterparts across the country, make it more challenging for us. So, great question. Yes, sir.
Barbara's comments generated a question. So I know over the years, since a lot of those other factors across the country have influenced recruitment, are you seeing those numbers still low of an interest in the career, or are you starting to see some increase in?
We've definitely seen an uptick. Yeah, I wouldn't say we're back to where we were. I don't have the numbers off the top of my head, but we are definitely seeing an uptick. I mean, boy, for a while there, we were scrounging just to get, enough to make it worth having a test. That has changed. And so we're doing much better. Yeah.
Good. Thank you.
Yeah. Thank you.
Thanks, Chief.
Okay, the next section we're going to dig into the nuts and bolts of the budget. So we'll go through each fund and talk about what's changed and what might be new.
Before you start, let me just ask, does anybody need a break?
Yes.
I sort of thought.
Yes.
Yes, all right.
5 or 10 minutes?
Yeah. I was wondering why you were tapping. Okay, now let's go ahead and regain our budget retreat or restart it. So turn it back over to Drew.
Right, so now we're going to turn our attention to funding the work, which is where we're going to talk through the nuts and bolts of what's changed in the proposed budget. So where does the money go? This breaks it down by general expenses. The top line there is a little bit misleading. It's very rarely parks, recreation, and culture, although Robbie probably is pretty excited to see it at the top of the list. The reason that bar is so large this year is because it reflects the library investment. So otherwise that would not be the top. What you would see is pretty typical of localities across the country: public safety and education always at the top of the expense lines and moving down from there. So just take a look at the general fund. We'll talk about it first. You can see here we break it down a little bit further in terms of expenses and revenues. Obviously, some of our bigger expenses are all of the departmental expenses, and then the schools come in right next to that. Just a little bit about the growth in the various areas of spending. The general government administration up 17.9%, almost entirely due to changes in compensation, right? So the proposed raises we're going to talk about in just a second, the structural changes to how we're compensating, particularly for certifications and things like that and public safety, all of that contributes to that growth year over year. So what's in the general fund? As you can see here, there's been quite a bit of change. The number one increase, education. Of course, when we approved the new school contract, it required a substantial new investment in this fiscal year, and so that is budgeted. Contractual service agreement increases. Outside agency funding, we did have two that had significant increases. The first I'm going to talk about is at the bottom, the regional jail. That increase is actually due to a change in federal funding reimbursement of the jail. And so all three localities are dealing with a pretty substantial increase in the jail funding. I can tell you that the jail board, which I serve on, did their best job to minimize that impact by using some reserves, pushing out expenses in the capital plan, but there's only so much you can do when you lose approximately $750,000, $800,000 of anticipated revenue. And then the other one is Williamsburg Area Transit Authority. We did talk about this one just briefly yesterday during the city council meeting in terms of what they're requesting. I mentioned that last year's budget actually included the amount required to start phase one of their improvement schedule. And so they have a strategic plan that they're following. It requires them to do more investment to get to faster turnarounds on their bus lines, particularly the ones in the urban areas, which benefit us greatly. They instituted a new route that actually serves downtown Williamsburg and goes all the way out to Target in the county, and that one will be one of the first ones to get a faster return time. I think we're going to see how that impacts ridership pretty quickly once that happens. In addition to that, they're investing in buses. They're also investing in predictability. So you'll be able to better see where the bus is and when it'll arrive. All of those things for rider convenience are important in terms of the system continuing to stay relevant, not just to the riders that have to ride it, but to the riders that want to ride it, which is obviously where we're trying to get in terms of the service. And then the other one that I just wanted to talk about briefly is a new outside agency for this year's budget is the Virginia Capital Trail Foundation. This is not an organization we have typically funded. As you know, last year, a big announcement was made. The Capital Trail Board extended their oversight to include the extension of the Capital Trail where it ends now in James City County through the city of Williamsburg. And so having them co-located in our building right now and pursuing this avenue, I think it's a great opportunity for us to become a supporting partner. As you can see there, the other smaller increases in terms of cost. And then as we shift to this side of the screen, you can see the salaries and benefits breakdown, the proposed cost of living increase of 3%, plus the option of a 2% merit. As we've talked about before, we do try to split up this increase. So this 5% gets broken down as a 3% cost of living offset. I think the estimate from the federal government is 2.8% right now. So we're pretty much in line with that. And then the 2% is based on your evaluation score. So if you're a high performer, you're going to get that additional 2%. If you're not doing great, you're probably only getting 3%. Right? I participate in the regional CAO meetings. We just had one last month, and this compensation plan is pretty much in line with everyone. Most people are shooting for 4 to 5%. When we do this way, the average for the organization is typically somewhere between 3 and 3.5% because that 2% floats right in the merit. And then we also do a process of every 2 years, a staff committee that I don't sit on, it's led by the Human Resources Director, goes through a compensation and benefits analysis with every department. So we do that benchmarking every 2 years. If you remember under the previous city manager, we did a complete benchmarking analysis. We made some significant investments to get salaries where that study said we needed to be. Many of the other localities are implementing past studies right now. Those studies can come with a humongous price tag. And so to avoid doing that, we do an internal process every 2 years to just try and stay where we should be. And that requires a little bit of investment. And so based on this year's review, $250,000 going to move certain employees up on the scales, try and get them to an average position based on our benchmarks.
Drew, real quick, just you mentioned the study that we did a number of years ago. As I recall, it was up in almost $700,000 that the city came forward to get our benchmark to where it needed to be.
That's
Is that
right.
over a 2 year?
Yeah, we ended up, the actual recommendation was somewhere in the neighborhood of $3 million, as I recall, Mayor, and that's been a long time ago. And that was to do everything that the consultant recommended. And we chose sort of a mid-tier step where we moved a lot of people up on their scale to try and get them to midpoint based on their years of service. And we were sort of successful. Not everybody got there. And then we switched to doing it this way. And so, yes, we've completed that process. And now this is a much better way, I think, of really digging into the departments directly and making the adjustments that the department heads feel are warranted.
No, and I think it's better that we do it this way as well because it's easy to fall behind.
Right. Well, I mean, if you look around the region right now, I think York County and James City County both are on the tail end of implementing a past compensation study. And it's typically millions of dollars to take those initial steps. I mean, very few localities can afford to do what the consultant recommends. So I think this is a much better approach.
Thank you.
Oh, let me go back. So the other big part of the increase in general government is this budget proposes adding 13 new full-time equivalent positions. And so we'll go through that in just a second. When we did that the meetings with all the department heads and constitutional officers back in December, they pretty much only requested staff. And we ended up with way more requests than we could actually fund. As you can see here, it was 23 new FTE requests during that process, which would have totaled $2.1 million more in the budget. And obviously, we could not afford to do that as we tried to balance. So we ended up with 14. As you can see here, we broke it down based on need: 3 for the fire department, 3 for the police department, 3 for public works, 2 for parks and recreation, a half of a position for planning and codes compliance, and then WRHA registrar and the city manager all get a half as well. So that's the breakdown. Now, in addition to this, we will also be doing a little bit of restructuring where we're going to take an existing FTE and move it to another department that needs it. It's a vacant FTE position, partially funded. And so that'll be in addition to this, but it doesn't affect the FTE count.
Is it 13 or 14?
It should be 13. Yeah, it's 13.
14.
Okay. Yeah, it should be 13. I'm sorry. So that's the breakdown of the FTEs. Now, I will tell you that as we move through from now until March, there may be some adjustment of this because if we identify staffing needs in other departments, we may shift these numbers around, but it'll have to be within the window of that dollar figure. So there won't be any new FTE proposed, and it won't go above that 1.2 million. So what wasn't included of the requests? As you can see here, these are the things we strive for a budget reserve that exceeds what's recommended by Davenport. Every year we try to put a little bit of money into that fund. This year we're not able to do that. That actually continues the trend from last year. Also, the City Council has asked us to start working on weaning ourselves off of the HUD funding. I think now more than ever that's a good idea. Again, we're not able to make a lot of progress in that regard. Unfunded position requests, 3 additional public works, 3 additional for police, and 3 additional for the fire department. And then on the outside agencies, a total of 115 were not funded. $115,000 worth of requests were not funded. And then we're still waiting on the health department numbers. That usually comes very late in the year, sometimes after we've already started the fiscal year even. And then the James City County Joint Activities budget request, we don't have that either. Everything else we pretty much have, with the exception of the city's health insurance. So we won't get that until usually the end of February, early March, and we'll have to see what that looks like. We have had years where it was a 0% increase. We even had, I've never seen this before, but we had one year where it was a decrease. So fingers crossed that Dawn can work her magic and bring in a low number. So let's talk about the utility fund. Not a lot of change here other than the borrowing plan for the capital investment. And so when you see the growth in the budget, that is where it's at. It's all on the capital project side. Everything else is relatively nominal. Let's look at the regional utility rate comparison. This is actually easier to do now since we started doing monthly billing and separating out HRSD from the city water service. And as you can see there, we still are the second lowest in the region. And if I believe correctly, it's not even a real fair comparison because I don't think Franklin does true water treatment. And so the analysis of rate, we probably could take Franklin off because it's not apples to apples.
They just pop it in from the James River? Or?
I'll have to let Jack answer that. Utility needs, I think this is the most critical slide, maybe in the whole presentation, because I know that the public and certainly the council are looking for where's the increase in rate. This is the only one that we're recommending. It's the same avenue as we forecasted last year. One of the things that we said about utilities is that we needed to get back in the habit of every year raising the rate some, right? And we said it could be as much as 10% every year. I don't think we'll ever hit 10%. It just depends. We could have a terrible situation where we need to make an unexpected investment, but I don't think that will happen. The idea is to keep dropping the rate increase from the rate that we did last time. And so this year we're proposing a 7% increase. And what that does, it sets us up very nicely to drop the rate lower and lower, the rate increase that we're recommending lower and lower year over year until we get to a point where we really are just offsetting the growth in the cost of service. It'll be a nominal rate increase every year thereafter. So what we're trying to do is accommodate the debt schedule that we need in order to make the investments Jack has planned, but at the same time not overcharge the public. And so that's what this is about. As you heard, Davenport is going to be assisting us with a rate analysis. We're going to be looking at how can we change the rate structure to make it easier on our customers. We're going to be looking at tiered rates, which I think some of the members of the public had suggested us consider. We're going to look at all of that in the coming year. as you can see here, even with the 7% increase, there's very little change in the rates. I think it's like a $3 increase on the residential side, and then a $20 or so increase on the commercial side in terms of what you consider to be like an average consumer. The tourism fund largely remains unchanged from years past. There's a little bit of growth in outside agency expenditures and whatnot, but again, as I said earlier, when we looked at the CIP, the thing to be cautious about here is that the tourism fund is predominantly funded by sales tax as well, right? Our dedicated share of the 1% historic triangle tourism marketing tax. And so as sales tax is slowing in that growth, that means the revenue coming into the tourism fund is also slowing. So one of the things City Council did to accommodate for that is we've suspended the grant program, which I think was a wise thing to do. We'll stabilize the money that we're paying out as a result of those grant awards, and then get to a point where we can adjust the tourism fund to look at doing those grants again at some point in the future. And you can see that here. The tourism grants awards is the only change really, and it's a decrease from what we've had in years past. The capital improvement fund remains the fund that we keep an eye on because, again, the sales tax is the factor here. As you can see, and as we've explained in your handout, there's not a lot of new projects in this CIP, and that was by design. We had to go back in as we did the wish list and cut to get to a balance point. So there's not a lot of room for growth here. This is an example of some of the projects that are in and some of the projects that are out. At the top, Trail 757, now known as the Capitol Trail as it comes through the city. There's a $3.5 million investment there, but we're anticipating actually all of that is going to be grant funded. Last year at this time, we thought we were going to have an investment maybe in the $1 million range. But now it looks like actually all of it will come through in grants. So we'll keep our fingers crossed that that's what happens. I'm going to pause there and just make the point that as you look, and we're going to make a slight change in how we produce the budget this year to hopefully illustrate better projects that are grant funded or even partially grant funded from all the rest, just to make it a little easier to understand. But I think it's important to say that if we are budgeting this project at $3.5 million and it's based on partial or complete grant funding, and one of those grants doesn't come through, then we have to come back to City Council and say, there's been a change in strategy here. What do you want to do? Do you want to push this out, or do you want to put city funding to fill that gap? That'll be the question. So just because it's in the plan does not mean we will be pursuing it. Next is Lafayette Street reconstruction. There's a $2.7 million commitment there. A lot of that is grant funded. There is now a city share, and so we'll need to talk about how we're going to accomplish that, but it is budgeted to be in the plan this year. We're going to paint and repair the transportation center. We're going to make a small investment to child development resources to hopefully fulfill the city's commitment toward their capital plan. It's my understanding all of the other localities will be doing the same in some way. So hopefully we can finish out their financing campaign for their new building, which I think all of you have seen. And then a new project that we wanted to fund is Duke of Gloucester Street bollards. If you've been attending events downtown, you've seen that we've stepped up security a little bit. Jack and his team have been loaning our larger vehicles to serve as barricades. Our trucks look better than most on the public side. You've certainly seen a lot of other public utility vehicles. They don't look as nice as ours. But still, it'd be better to have something that's a little less intrusive and more keeping with the design standards for downtown. And so we've been seeking grants. Again, this is another grant-funded project to try and accommodate putting in what we consider to be phase one of these very expensive bollards. The difficulty with this particular project is if you look at its totality, downtown is humongous with so many access points. You're talking about a very expensive investment to do this fully. Pat Dent and I worked on this when he was the fire chief. It's not an easy thing to do, but if we don't start, we'll never get finished. And so we're going to start looking at whether or not we can secure some grant funding to take a first step.
And when you say bollards, are these ones that are in the ground and then they pop up?
Yeah, in certain places where access is frequent, we would want bollards that are retractable, right? So as an emergency services vehicle approaches, the signal alerts it and the bollards retract automatically. In other areas, we can do the manual removal system, which makes them a lot cheaper. But obviously that retractable feature is a nice spot when you've got frequent access issues. Unfunded projects. So these are projects that were in the plan that have now been removed. The first one, I know everybody's going to be excited to talk about, is the Monticello Richmond Road Roundabout project. We talked for at least 2 years now that a flaw in, at least Drew's opinion, a flaw in the state VDOT program Smart Scale is you apply for the funding, you get the funding, and then, or the funding is awarded, but you don't actually get the money for another 5 to 6 to 7 years in the plan. And what localities didn't do and VDOT was not prepared for was escalating the project costs between those years. And so right now, across the state, localities have projects just like this one where they have gone from 100% funded to, oh, you're going to have to pay a fairly substantial amount of money because we didn't budget for that escalation. And so what you'll see now going forward with Smart Scale is actually a little concerning to me because localities are going to start budgeting for escalation. And I guarantee you everyone is going to do that differently. And it's going to end up tying up money in the Smart Scale program, probably unnecessarily. So it'll be interesting to see how VDOT adjusts their approach to Smart Scale to accommodate this problem. With the Monticello-Richmond Road roundabout, we ended up having to come up with about $1 million to push that project forward. Now, that was a very low percentage of the overall project cost, which I think was slightly more than $8 million. But still, it's an investment, and based on the input from the city council, the input from the public works department, it does not seem like a project we should proceed with at that kind of investment. Maybe it's something we circle back to in the future, another Smart Scale application if that's what we want to do. But at this point, it's probably not a good idea. We are going to ask VDOT if we can take a little bit of the money that was allocated to that, not through Smart Scale, and move it around in the plan to accommodate what we might have to pay for Lafayette Street to accomplish the same goal. If they're amenable to that, then it'll lower our investment in Lafayette Street. We'll have to see if that pans out. The next one is softball field lighting. As we really focus on sports tourism, Robbie is doing all that she can to make her assets attractive in that regard and support what the needs are. We did lights at Kiwanis Park. There's still a field, at least one, that has the old lighting, and we'd like to upgrade it so that it's consistent with the rest. And we've heard that from feedback from users. Unfortunately, it's just not a project that we can accommodate in the CIP this year. Highland Park CDBG, this is a program that we've really been trying to get done, where we would go in and look at improving sidewalks and drainage neighborhood-wide. It's something that the neighborhood has asked for. We're not sure how many of the neighbors really support this concept, though. And so our idea was to apply for a grant that would help us go in and assess interest, where we could sit down with each neighbor and say, if we do this, this is what you could expect in your yard and for how long, right? Because what you're talking about is a very invasive project where you have to dig up very deep trenches to put in true curb and gutter stormwater systems. It'd be a major improvement for the neighborhood, but a major inconvenience during construction. We've applied for grants to do that work consistently and been denied. I think we've just received notice this past month that we didn't get this year's grant award either. And so we've taken out the larger investment, 2.75, but we left in a little bit of planning money. I've talked to Nicole about doing our own outreach campaign to see if we can assess that interest level without all of the planning process that comes through the state award. Next is the necessary and needed replacement of the playground at Waller Park. If you haven't been out there, you should take a trip. It's a very old playground piece. It's very old playground equipment. It needs to be replaced as soon as we can. But again, we're just going to take that out of the plan for now and see if we can address it later. And then the last one is everybody's favorite project that never gets done, the quarter path HVAC replacement. You may remember last summer it was quite hot in the gym for a few days, maybe a month, while we tried to repair an obsolete HVAC system. But unfortunately, it's a massive cost in a building that's future is uncertain. And so every year it seems like we either push it out or take it out of the plan. Just know that the day is coming when Jack and Robbie come to my office and say, Uncle, we can't keep doing this. We've got to make this investment. And if that happens, then we'll be looking to reserves or the contingencies to accommodate that expense.
Didn't we approve repair money yesterday?
Yesterday you did approved a chiller replacement, but doesn't really solve the whole problem. But it did bite into this a little bit. This used to be over $1 million worth of cost, so we lowered it a tad.
I have a question about the transportation center, and I'm sorry if I missed this. Recently, we had talked about the necessary repairs for following the impact from the accident. So can you tell me a little bit more about that project?
I can start and then I'll let Jack finish. So, where the transportation center sits, the coal trains pass it every day. It gets covered in coal dust, and it's a building that we get a lot of complaints about. It also gets a lot of use. I mean, you look out the window right now and see the water buses loading. And so it takes a lot of abuse, particularly inside, but outside as well. And so it's time to do a pretty significant overhaul of the exterior. Jack, do you want to talk about repairs at all?
We're also looking at upgrading their offices and budget depending, try to add additional beds. I'm not sure it'll stretch that far.
Yeah, if you go in the building, there's a couple of offices on this side that belong to WADA, and they're in pretty rough shape. And as their landlord, they've toured us through and asked for investments to improve working conditions. Any other questions about funded, unfunded? We've given you a handout that gives you a bit more comprehensive look at it. And of course, you're going to be seeing the whole comprehensive or the whole capital plan and can start to formulate what you think in terms of what should be in or should be out. If there's something on the out list that you think should be in, just keep in mind, we're going to have to take something else out to get to that. So next is looking at what I'm recommending for a tax rate. I'll skip to the end and tell you that I'm recommending we keep the tax rate the same. One of the factors is that our general fund balance is quite high. But again, it's a little bit artificial because it's got some of that school money in it that's considered committed to the schools. Obviously, you all would have to approve that award, but that's what the general intent was. So we don't really consider that available to us. It's not the majority, but it is a healthy piece of it. We don't have the kind of balances that Barbara and I were aiming for in our school stabilization or general fund stabilization lines. And those are really just there to be cushions for if something happens in the budget that we didn't expect. Some revenue comes in much lower or something. And so that makes us a little bit nervous. Assessed values are not growing at the rate that they were. $1 million worth of revenue, as you can see, does not go a long way as we talk about the growth and expenses of operating local government. And of course, economic conditions are still just as uncertain as they've ever been. Our fiscal health is very strong, though. I mean, as you look across the state, the Commission on Local Government does a study, and we are consistently number one or number two in terms of fiscal readiness statewide. And that's really something that we should all be proud of. But at the end of the day, I think our low tax rate is sufficient. We need to hold that line. One of the things that's different about this year's budget retreat is we normally have all of last year's revenues to predict new revenues on. And we don't have that this year for meals, lodging, and the new admissions tax because they were just imposed at the beginning of the year and didn't get implemented until the beginning of this month. And so we just don't have enough data to really be certain about what that's going to produce. It's our hope that our estimates are low. And maybe we'll have better data mid-year and I could look at some of these things that aren't included to be included or otherwise reducing the budget. That'll be a question for City Council. Otherwise, that new data will become part of the relevant conversation as we move into the budget process for FY28. Looking at the CIP health, this is something that we stay focused on, but particularly since last year's rate increases were designed to prop up the CIP. And as you can see, we're still looking at a success there, but the margins are tight. So as you look at the CIP list and think, boy, it'd really be great to do that project, just keep in mind, there's not a lot of money held in reserve there. And so it really is important that we take a project out if we put a project in.
Is there any way that we can change how we fund the CIP if the sales tax continues to decline?
Oh, of course. It's up to you how you fund it. We do budget for a transfer. When you dig into the budget, you'll see that every year there's a transfer from the general fund to the CIP. What we do there, though, is interesting, and I think it's skill on Barbara and Davin's part. What we do is that transfer is budgeted, but we don't make it until the end of the fiscal year. And what that does, it allows us to keep as much money in the general fund as we can. Right. So as projects in the CIP either don't get done, come in under budget, or we get more grant funding than we thought we would get, we're able to reduce that transfer to continue to keep money in the general fund, which ultimately falls into fund balance. And so I think that's an excellent strategy. So while we say it's funded by the sales tax, and it is, there is some assistance provided by the general fund almost every year.
But to that, one of the things that you mentioned is, we as a council have asked you all to tighten
That's right.
Right.
revenue and expenses, which leaves less money for transfer. Where years past, we would always have that $2 million gap, and then that would support our CIP. And we've taken that away, which the consequence is it makes it harder to manage our CIP.
That's right. Absolutely. It does make it a lot harder to add really expensive projects. So we just have to keep an eye on it. As I said, the margins are tight. They're not impossible. And as we start to get these new revenues in, the idea was it would offset some of that transfer money. And then, maybe these balances will start to grow a little bit and we can look at adding some of these projects back in that have been cut over the years. The fiscal health forecast, and I skipped ahead and talked a little bit about this. The budgetary changes impacted fiscal health. Not really a change. Years ago, the city council said you wanted to be a premier employer. That's a part of our compensation plan. So when we look at percentages for increases every year, we try to be consistent with the other localities so that we don't fall behind in that point. The CIP costs, inflationary impacts on the budget, and of course, increasing in school operating costs and changes in how we budget for school CIP. It's a brand new process, and so we just need to take a minute before we make really big decisions to be sure how it's going to play out for us as we move through the future, particularly as enrollment is a factor in what we're paying every year, and it's not necessarily that predictable percentage that it's been. Indicators that we're preparing for is the decreasing annual surplus. The mayor just spoke about that. Increasing service demands, the cost of services exceeding revenues, the school changes, which I just talked about, interest rates, utility fund investments. So a whole host of things that we're trying to keep an eye on. So the steps that we've taken is we've continued to plan strategically. We invest where the community tells us that the values are for the community. We haven't made a lot of progress toward our debt service and HUD reserves that we're trying to create, but it remains a target. And then working with our financial advisors to make the most of debt, continued investment in new tourism assets. Obviously, that's about growing the economy. Reduce CIP project scope. Last year we cut $30-something million from the CIP at this point in the budget process. And this time, I think around $14 million to get to the balancing point. Instituted a new outside agency review process. I think that's critically important. Last year, it saved us about $37,000 because we just had more eyes on the applications. And I think that will continue as we evaluate these new applicants that come forward. And so steps that we might consider taking, we need to continue to invest in workforce recruitment and retention, because if we can keep an employee, it's a lot cheaper than bringing in a new one. One of the things that you all have been great about is allowing us to invest in benefit programs that are unique and different. And that really does allow us to sit down with an employee who's either coming in for the first time or thinking about leaving and say, you need to compare not just the salary, but also what you're going to get short-term, long-term in terms of benefits. And very often that's a difference maker for the employee. The rising costs of school operations and CIP changes, I think we took a major step with that in terms of our contract renegotiation. I think long-term that's going to benefit the city tremendously. So we'll see how that plays out. We need to continue with our utility rate plan. As I said, our goal is to continue to drop the recommended rate increase. It'll never go away, should never go away, but it also doesn't have to be 10%. And so our target is to keep dropping it down while at the same time providing the operating capital that Jack and his team needs, not only to do the work, but also to finance the improvements that are required. Adopting some additional utility fund policies will be necessary to move through this, looking at that rate study and deciding how we want to deploy that. Do we want to do tiered rates and that kind of thing? Does it make sense for us to do that? That'll be something that we look at. And as I said, mid-year, we're going to sit down with Barbara and look closely at these revenues that are coming in off of the taxes that you all approved to see if they're performing in line with what we thought or better is the hope. And if it's better, then we'll come back to you with a report and a recommended course of action. Either stay with what we budgeted or add some projects in that you thought were worthy of considering, maybe some of the FTEs that didn't make it in the first round. But ultimately, I think we're in a good position in terms of the city's budget. As you can see, the budget really is pretty straightforward. There's no recommended increases in taxes. There is a 7% increase recommended in the utility rate. Other than that, it's balanced on the operating side and on the capital side. At this point in the year, we usually have some pretty significant unknowns still, but this year we don't. And one of the reasons is because the school contract is known, right? So at this point, we're much more confident in how that's going to impact the balancing process. So it really is just down now to the health insurance. So as you all take this budget over at the end of March, assuming we don't have major changes that you'd like me to make before March, we're going to be operating within this window. So I think, this is a pretty solid budget for us. It provides us with what we think we need to move through the next year. It sets the departments up to accomplish the goals that you've given them, but at the same time is not overly taxing on the citizens. With that, we're happy to answer any questions.
When you're looking at revenue, specifically tourism type revenues, obviously we've implemented an increase, so we can anticipate that next year. But beyond that, are we at a point where we can do any forecasting based on state numbers and what they anticipate, looking at 2026 increased visitation? Have you plugged in a number, or Barbara, have you plugged in a number, the 3%, 2.8 to 3.5% growth in revenues next year as a result of that?
Yeah, absolutely. We've done that. Now, what I will offer as a cautionary note is we have not tried to say, oh, well, the sports center is going to be open and we've got all these nights booked, and so that's going to be the impact of X, and we should put that in the budget. We've not done that. I think that would be irresponsible to do that at this point. We really need to see how that performs, particularly because, the news is fantastic about how well the sports center is doing before it's even open in terms of attracting tourism. But what we don't know is where those nights going to end up being, right? Are they in the city or are they in the counties? How much of the meals tax that gets generated by those patrons is going to be in the city versus in the county? So I think the responsible thing for us to do in regard to those particular tax growth is to wait and see.
Would be a pleasant surprise.
That's right.
Right.
Fingers crossed.
All right. So in terms of some of the capital outlays, I really do think it's best that we don't look at doing the roundabout and try to find extra money there. But the question about Lafayette Street, I do think should remain a priority. It's a street that many travel. It's congested. It's cumbersome, and so trying to understand what our commitment to that will be, I think is going to be important, because I think that's a project that needs to be done.
Yeah, I'm sure I'll have a ton of questions after I've had the opportunity to digest it all, but the one that just comes to mind right now is, and pretty sure I know the answer, this doesn't include the funding increase that was requested from the schools.
So, correct. Let me just get it clear though. So what's included is our contractual obligation. What's not included is your recent meeting, and they requested $2 million more dollars from localities. So we've not included that. We've done the analysis of what that might mean for us. My recommendation is wait and see. There's a $2 million request on the table. None of us know what the state funding actually is going to be. I say we wait and see what that is before we make any real big adjustments to our budget.
And I think it was the first time since I've been on council that they presented what this 1.9 or $2 million that they're requesting would equate to the project. So we would know if we're not funding it, what's not going to happen.
Exactly. And that was all part of the renegotiated contract, was to give more transparency on when they ask for money, what would it be used for, and how would it change the outcomes that they're producing, which I think is really the key component of asking for more money.
So thanks. The only, I'll have lots of questions I'll just talk about as we move forward in the process. This is just the top of the conversation. But one other kind of timing unknown that I was wondering is that you mentioned with the Lafayette Street that, partial grant funding, maybe more grant funding. When will we know that? What is our share? What would be our share of the Lafayette Street reconstruction?
So I can't give you an answer for that because we're way off the roadmap for smart scale, right? So I'll give credit to Jack completely. We had a whole list of projects. I'm going to get it wrong, but I'm going to say 5 or 6 of the smart scale projects that ended up needing more investment from us because of the escalation in cost from the time that we applied to the time the money's actually given to us. A couple of those, the increases were nominal, like $19,000 or something, and so we didn't bring that to you today. It's just included in the budget. The bigger projects, though, we made a decision. That's why we took out the Monticello roundabout based on what I thought your all's collective feeling was. With Lafayette Street, our investment required is around $1.3 million, I think. What we're going to do is go back to VDOT and ask them to help us with that. I don't know what that will look like. They're already giving us some of the escalation funding. What we're going to try to do is ask them if they will let us have some of the escalation funding they had offered on the Monticello project go to Lafayette to pull our number down some. I don't think we'll get to zero because I don't think they will see that as fair to the other localities, but we might get it down a little bit more from what it is now. And if that happens, it will just help the CIP's budget balance. Is that fair, Jack?
Okay, all right, thanks.
If I could,
Oh, I'm fine, I don't have
the-
anything like that.
you know, when we talk about roadways, Vice Mayor and I were talking about this morning. Capitol Landing Road is so bad. Is there anything we can do to advance that project? And I know, is there anything we can do to advance that project?
So I'll answer that two ways. First way is by way of explanation. The delay between us installing the water line that made the road bad and fixing it was because we were waiting on the federal government to tell us that we could proceed to the next step, which was right-of-way negotiation, right? We only needed right-of-way from one owner, and we had already secured their consent. So it was very frustrating for us to wait more than a year to get federal approval. We got federal approval, and the next day, the government shut down. And so we were delayed again, and then as they restarted and people had left and they had to reassign the project to somebody else, it's been a slow go, right? Now we will start to see that project move forward. So the actual project in the CIP will begin to proceed, right? What can we expect in terms of construction start, Jack?
It's likely going to be this time next year.
Right. So we're still a ways out. Now, what we did do is quantify, this is the second part of the answer, quantify what would be required to make the road better in the meantime. And it's about $80,000, Jack?
We're still looking at that. We actually are meeting with the group soon to call it just scratching it, and we can smooth it out a little bit. It's pretty, but it'll drive. We're working on getting a price on that right now.
So the reason we haven't done it is because, you know, we don't know when that next step will be. And it seems like a shame to make a big investment in a road that we're literally just going to tear out and do again.
If we have another government shutdown between now and then, I mean, we're looking at, you know, it could be 28, the latter part of 28. Sports Center is going to be open. I drove it last night.
It's terrible.
And it's horrible.
It's terrible. Just say the word, we'll spend the money.
I had two questions. Barb, did you have any questions? Okay. So the first one's pertaining to Trail 757. With that being like the most expensive CIP project, when would we expect to hear back from if we got the grants for covering that?
We're going to hear very soon, I think. I hate to speak out of turn because it's really not, the city's not running point on those grants anymore. One of the, I think, advantages to us, because we just don't have the bandwidth to do it, is Will Gillette is the local Capital Trail person now. We're actually housing them part-time in our building. He has been working on a budget amendment with the State General Assembly, so we should know that fairly soon. And then the second piece was a grant application that we made through the HRPDC for state funding. I think Transportation Alternatives was the name of the grant, and we should have that answer very soon as well. So if those two pieces come together, it's our belief we won't have any city cash involved in that project.
That's great. My second question is with HUD and not knowing where that stands forward. So if we lose funding for HUD, where does that come from? Like,
it would have to come from the budget. Yeah, I mean, if let's say we got word and, you know, the federal budget is October, let's say we get word in October that they are not going to continue to fund local housing, then we'd be coming to you looking for in the neighborhood of around $800,000 that would have to offset the revenue that WRHA receives from the federal government. You know, while that is a terrible thing to happen to us, we are probably better prepared than a lot of localities to deal with it. It would hurt many of the localities much more than us. I think in terms of benefit, because it's always important to look at the silver lining, we would be asking them to let us out of all of the restrictions that come with federal funding that apply years after receiving the money in return for that. And I don't know that we'd be successful, but that's certainly what we try. I imagine every locality in the country be trying the same thing.
Hopefully, we don't get to that point.
Hope not. Hope not. Any other questions?
No, so I think no, I don't. But just to recap, the next step for us is obviously to have some more conversations with you, give you some guidance. Your target is by the end of March to?
Yes, we produce the city manager's budget at the end of March.
So there'll be opportunities for the public to weigh in at next city council meetings in March. Anything else? Do we have to, okay. Don't have an agenda, but.
It's not on the agenda.
All right, well, if there's nothing else, then I'll take a motion to adjourn.
So I move that we adjourn.
Okay.
Ms. Williams. Aye. Ms. Ramsey.
Aye.
Mayor Pons. Vice Mayor Dent.
Aye.
Ms. Kershner. Aye.
Thank you all.